Good evening. Welcome to STC's educational webinar, Real Estate Investing in a Self-Directed Retirement Account. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm very glad to have you with me this evening. As we get started, I do want to give you a bit of preliminary information about STC. We are a retirement plan administrator only. We do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any particular investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, this evening's webinar is going to give some general information about self-directed retirement accounts. We're going to go through some of the benefits of self-directing, guidelines that must be followed in all retirement account investing, tell you a little bit about the specifics of what STC particularly offers our clients, and then we're going to talk about choosing and funding a real estate investment and how purchasing a real estate investment would work with STC. And then I will have a time at the end for your questions. Self-directed retirement plans. I want to start with a definition. What does that mean? It means that you hold your retirement account plan with a company that permits you to choose any type of asset that is allowed by law, anything that the IRS regulations or Department of Labor or ERISA laws allow, not simply assets that the company is willing to hold. So anything that is allowed by law, you're permitted to invest in a truly self-directed retirement account. This, of course, would include what some people consider as non-traditional retirement assets like real estate. Self-direction also means that you manage the investments in your retirement plan. So, for example, if you decided to purchase a property in your retirement account and you decided you wanted to rent that property, you would determine the rental rates. You could choose who the renters were. You would decide what improvements you wanted to make to that property. You manage the investments, so you really have control over those investments. That's a truly self-directed retirement plan. Now, a self-directed plan is not a type of plan. Rather, it means you hold it with someone who permits you to self-direct. There are a variety of different retirement plans. You've probably heard of many of these. A traditional IRA and Roth IRA. These are plans that have identical annual contribution allowances. With both of these, you can contribute $5,500 of earned income. And if you are 50 years or older, you can increase that to $6,500, an extra $1,000. The difference between these two plans is that a Roth IRA, unlike a traditional and most other retirement accounts, when you take distributions upon reaching retirement age, qualified distributions, those distributions are not taxed. They aren't included in your taxable income. So what that means is, when the monies grow in your Roth account, they are growing tax-free. Now, one difference is that when you make a contribution to the Roth account, your contribution is taxed in the year that you earn those monies and you are taxed in that year. But then any growth that happens in that account, once you take qualified distributions, is not taxed. So that's a tax advantage that Roth accounts have, and if you don't have one, you might want to look into that. A SEP plan is a simplified employee pension plan. Sometimes small businesses will have this type of plan, or even sole proprietors. It permits you to make larger contributions. You make contributions from the earnings of your business. So if you're a sole proprietor and you set up a SEP, the monies that you earn in that business then become accessible to make contributions into the plan. And those plan allowances are higher than a traditional IRA or a Roth IRA. In fact, for 2017, those amounts were $54,000 was the maximum you could contribute to a SEP plan. And just FYI, if you do have a SEP plan and you haven't made your contribution to it yet for 2017, you still have time to do that if you haven't had your taxes completed yet. You can make that contribution up to the tax deadline. So you may want to do that if you have not yet and you're eligible to do that. A simple plan is a savings incentive match plan. Again, used by maybe a partnership, small business owners. Again, allows larger contributions for, I'm just looking at for a simple plan for 2017. If you are under age 50, your maximum annual contribution is $12,500 for a simple plan. If you're 50 or older, it's $15,500. So you can see those are significantly larger contributions than you're permitted with a traditional or a Roth IRA. And now I've brought out onto your screen 4 different plans that all say former employer. A 401k is a regular corporate retirement plan. Usually for-profit companies will have 401k plans for their employees. 403bs are often used by charitable organizations or nonprofits. TSAs are tax-sheltered annuities, and TSPs are thrift savings plans. So if you formerly worked for an employer and you participated in any of those 4 types of plans, you can move those monies out of that plan and put it into a plan that you qualify for, say a traditional IRA. And then you could choose if you wish to self-direct those monies if you worked with a self-directed company. So if you formerly worked and participated in one of those plans, you can roll those monies out into a different plan. Now, I've also had some folks ask me, they say, you know, I've moved around, I've had a couple different jobs, and I've had some money in 401k here and 401k there, and different pots of money. What you can do is you can roll all those pots of money into one account and give you a little bit more funds in a single account to transact in investments. So you can do that if you wish. You can hold multiple accounts as well. So these different types of plans, traditional, Roth, SEP, simple, they can all be self-directed. These lower types of plans, you would be rolling the money into one of the upper plans if you wish to self-direct it. So let's talk a little bit about why you might want to self-direct your retirement account. With a self-directed account, you can gain true diversification into a wide variety of different types of assets. Most financial planners say that diversification is a good strategy, and so being able to diversify into assets other than stocks and bonds and mutual funds may give you a better retirement portfolio look. So you can invest in real estate, you can invest in mortgages and notes, you can invest in private businesses. I will talk a little bit more about some of the detailed investments that you can make in a self-directed retirement account. But really, there are very many things you can invest in and very few that you are not permitted to. And I'll talk about those in a moment too. As I mentioned, you choose and you control the investments and the transactions related to them. You can also increase the buying power of the dollars in your retirement account by using leverage. That is permitted on a real estate asset. I'm going to go into detail on that, but that does give you a little bit more buying power using leverage to purchase an asset, a real estate asset in your retirement account. And because of all of these things, you may be able to experience a higher return on your investments than you could if you were invested in things that you really had little control over, except choosing to own or not own them. Let me talk a little bit about the guidelines for self-directing, because there are things that must be done related to all retirement accounts. There are administrative requirements that must be fulfilled. Every year, a valuation of your account must be made, and it must be reported to the IRS on Form 5498. Books and records of all the details of the transactions that you make within your retirement account must be maintained and recorded. So if you purchase something, the purchase transaction, if you're earning income on it, the income going into the account, if there are expenses going out of the account, if you have taken out a loan, you've leveraged that purchase, then the payments, the interest, that's been paid, all of those transactions and details must be maintained in the books for your retirement account. State filings may be necessary depending on what type of investments you own and where you own them. And in rare occasions, tax returns can come into play. I'm going to talk a little bit more about that in a moment. Let me just say right here that STC is a full-service retirement account administrator. So we will fulfill all of these administrative requirements for your account with us. With one exception, we are not permitted to prepare any tax return that might be required. But what we can and will do is give you all of the necessary records and documentation so that you or your tax preparer can complete any tax return should that be necessary. Again, that's a pretty rare occurrence. A few more guidelines for self-directing. I mentioned that there were very many assets that you can invest in, but there are a few that you cannot. There are two different types of prohibited assets, things that you may not own in any retirement account, whether it's self-directed or not. And those are life insurance contracts and collectibles, things like rugs, works of art, stamps, coin collections. Neither of those assets are allowed in a retirement account. There are also some transactions that are prohibited. Your retirement account is given tax preferential treatment. Basically, you're not taxed on the earnings in a retirement account until you begin taking distributions. A retirement account is given that privilege because it is meant to benefit you when you retire. It's meant to accumulate wealth and grow in wealth so that when you retire, you can, take distributions and live on those distributions. So the transactions that you engage in for your retirement account do need to be for the exclusive benefit of the plan. You can't use those monies in a way that profits you personally, but doesn't profit the plan. That would violate the prohibited transaction rule. You also cannot personally borrow money from your retirement plan. That is a prohibited transaction. Now, you can loan money to other borrowers from your retirement account and hold a loan or a note in your retirement account, but you can't personally borrow money from your retirement account. You also cannot pledge your retirement plan assets to secure a personal loan. They cannot be collateral or security for a personal loan. That would violate these IRS rules. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. Now, I told you just a few moments ago that you could use leverage to purchase an asset in your retirement account, and you absolutely can, but it cannot be a personally guaranteed loan for your retirement account. In fact, it must be a non-recourse loan, which I will describe in a few slides and explain a little bit more. So you cannot personally guarantee a loan for your retirement plan. You also cannot benefit any disqualified person by a transaction that your retirement plan engages in. You can't benefit any disqualified person. So let's take a look at who those disqualified persons are. And you'll see the first person I put out on the screen is you. You and your retirement plan are two separate entities. You cannot do a direct transaction with your retirement plan. And let me give you an example. Let's say that you personally own a rental property at Myrtle Beach, and you rent it in the summertime and make lots of money in that property. Your retirement account cannot purchase that from you. That would be a disqualified, prohibited transaction. If you are married, this applies to your spouse as well. If your spouse owns that property, your retirement account cannot purchase it from your spouse. There are additional family members who are also disqualified. Other family members who are disqualified are ascendants, so that's parents, grandparents, great-grandparents on up the line, descendants, That would be children, grandchildren, great-grandchildren, on down the line. They are also disqualified persons. So if your father owned that property at Myrtle Beach, your retirement account could not purchase it from your father. If your daughter owned it, your retirement account could not purchase it from your daughter. That would be a descendant. However, lateral family members are not disqualified through your retirement account. So if your brother or your sister or your aunt or your uncle or your niece or your nephew or your cousin, if any of them owned that property, your retirement account could purchase it from them because they are not considered a disqualified person in this sense. There are also two entities that are disqualified. Any company if you're a majority shareholder, or any company if you're an officer, a director, or a highly compensated employee. Now, I do want to stop and elaborate here because I oftentimes am speaking with real estate investors, and they may be operating their real estate investing business through a company. Maybe it's an LLC, maybe it's an S Corp, but they are the majority shareholder. And perhaps that company owns a property. If that is the case, and you're a majority shareholder in that company, then your retirement account cannot purchase anything from your company because you're a majority shareholder. So that also would be a disqualified person prohibited transaction. So I just want to, I'm mentioning these things to you, not that we expect our clients to know all the ins and outs of the rules and the guidelines. This is really more to help you think through possible transactions you might be interested in. Because at STC, our job is to really help you, give you the guidance on making sure that your transactions are in compliance. So let me just take a moment to talk with you about the kind of approach that we offer our clients. We are a full service administrator. We set up your retirement account LLC structure, and I'm going to elaborate on this structure that we use for each of our clients' accounts. We have CPAs and attorneys available to answer any technical questions about transactions that you might be interested in engaging in. We offer unlimited guidance on transaction compliance. Our client service department is available to answer any questions, to walk you through paperwork, to help you understand what is within the rules and what is not, so that your transaction will comply with the IRS rules. We handle all of the back office support, meaning all of the paperwork, taking care of recording all the transactions and the details. And we will maintain financial statements for your retirement account. So you can really operate it like a business. You'll get a statement of cash flow and income statement. So you'll have the ability to run your LLC IRA as a business. We supervise the regulatory reporting, and we oversee that annual valuation that needs to be done every year to the IRS. So you don't need to worry about any of this administrative stuff. We do all of that for you. And that frees you up to focus on finding the best investments for your retirement account, because that's really what you want to be spending your time doing, not all of this administrative stuff. So that is what we do for you. I want to talk a little bit about the benefits of this LLC structure that we use. And we do this because we know that it offers each client the maximum flexibility in structuring transactions. You might have multiple parties to a transaction. You might want to use leverage. You might have one of your parties who's going to actually maybe be doing some renovation work on the property. Using an LLC structure permits you to structure a transaction, gives you lots of flexibility in how to do that. It does also provide an additional layer of asset protection because it is a limited liability company. It also gives you checkbook control over your retirement account fund. So that means that you have immediate response to investment opportunities. Now, you will notice that I have checkbook control in quotes, and that is because at STC, we do not give our clients the checkbook for their retirement account. And we do that really as a protection for them. We don't expect our clients to know all of the rules, and we wouldn't want to put you in the position of possibly engaging in a prohibited transaction unknowingly. So instead, what you do is you send your paperwork to us, call us up, we review it, we make sure that it's all in line, and then we can same day or next business day fund that transaction for you. So I call it protected checkbook control. You've got our experts looking over your transaction, making sure that it complies with the IRS rules. But you still have a quick turnaround time to get an investment funded, because we know, good investments can come and go really quickly. Using this structure also simplifies asset titling. For instance, if you were purchasing a piece of real estate, you as the owner of the IRA LLC can go to the closing and sign the closing documents on behalf of your IRA LLC. You don't have to send those documents to our office where they sit in an inbox waiting for somebody's signature. No, you go to closing and you can sign those documents. And this structure also makes it easier, simplifies pooling or partnering with other funding sources so that you can co-own an investment. And I'll talk a little bit more about that as well. So this is the structure that we set up for each of our clients' accounts. I want to mention that this LLC is not a generic business LLC. It is a very specialized LLC. Its articles of organization and its incorporation documents are written so that they comply with the IRS rules. So it's a very specialized LLC that we set up for each of our clients' accounts. Now let's talk just a little bit about choosing an investment. As I said, your investment opportunity is wide open. You have very many investment options with a self-directed account, and I'm bringing out onto the screen a number of different real estate investments: single or multifamily homes, vacation property, raw land, building lots, commercial buildings, real estate syndications, tax liens. All of those are different types of real estate. You can also invest in mortgages, real estate-backed mortgages, loans. You can make private loans. They can be collateralized if you like, secured. Private business investments, operating businesses, precious metals, the foreign currency, the Forex market, options, futures. And of course, you can certainly hold a portion of your retirement account in stocks, bonds, and mutual funds. So you can see that you can get a very diverse range of investments in a self-directed retirement account. Now let's talk a little bit about how you would go about investing your funds in an account with STC. This first step is optional, but I highly recommend it, and so does our client services department. You can request a review of the transaction and the structure of that transaction in advance. They are happy to look at your paperwork and documents and talk with you about how perhaps an asset should be titled, about structuring if you've got multiple parties. So you can request that. Then you request a transfer of funds. It's a simple form that we have. It's called a request to transfer funds, and you complete that form with the supporting documents. So who the seller is, where the funds need to go, how you want them sent, and then the details for the investment. And I'll talk specifically about real estate investment in a moment. Then you can fax or email that form to and the supporting documents to our client services department. They will review that transaction immediately, and then they will process that transfer request. They will send the funds from the LLC bank account to the seller, and then the seller will transfer that ownership to your retirement account. So it's a very straightforward process to invest your funds. You do have a 24-hour turnaround time on your investments. So once your account is set up, then when you have the documents to us with any supporting documents, if you have them to us by 2 p.m. Eastern time, we can same day fund that transaction. Otherwise, it would be next business day. Now, we do like to see the transaction in advance so that we know that everything is properly written, titled, You know, if we have any questions, if the client services department is looking at your documents, they have any questions, they will call you. They'll get in touch with you right away, see if they can straighten anything out that might have been a question so that they can go ahead and fund that transaction. But generally, we can do same day or next business day funding of your transaction. Now let's talk specifically about purchasing real estate. So your job as the account owner is to locate the property, find the investment that you want to invest in, and then you make an offer on that. Now, in this case, since you are finding this property for your retirement account, that offer must be in the name of your IRA LLC. And that's a name, the LLC name is a name that you will choose when you set up the account with us. So if your retirement account is purchasing this property, then the offer will be in the name of your IRA LLC. Now, you can partner your retirement account funds with other sources of funds. And they can even be personal funds if you partner at the inception of the transaction. So let's just say that you were going to do that. You had $75,000 of personal funds and $75,000 in your retirement account, and you are going to partner 50-50 ownership of an asset. Then in that case, this offer would need to be in your personal name and your retirement account IRA LLC name. So the offer must be in the name of whoever the buyers are going to be. If it's just your IRA or if there are multiple parties, that's how the offer must be made. And I will mention here too, you can't personally make the offer, have it in your personal name, but then have your retirement account want to purchase that. Because remember I said that you and your retirement account are disqualified persons. So you can't do that. So you do want to be sure that you make your offer in the name of who the owners are going to be. Now, oftentimes an escrow deposit is required. And if you do need an escrow deposit, then our client services department will need a copy of the contract that shows the IRA LLC as the buyer, as well as that request to transfer funds form I mentioned earlier. So we'll need a copy of the contract. And we do ask that you give us at least one business day before you're going to closing in order to process this paperwork. And what we will need is a HUD or settlement statement that shows the IRA LLC as the buyer and that request to transfer funds. And the latest we could get that is, the business day before you're going to closing. And we really would appreciate it if you would give us some additional time in case there is an issue with how the documents are titled. We can't wire the funds if the buyer's name isn't listed properly, or if we have any questions like a down payment that didn't come from the IRA. So we do have to follow those rules that the IRS has set out. So at least the business day before, but if you can, let us look at the paperwork several days before, that always makes things go smoothly. And our client services department is available to discuss the transaction with you. So please feel free to use their services. That's part of your, we're available for you as one of our clients. Now, typically the disbursement of the funds for purchasing real estate need to be guaranteed funds. So our clients usually request that we issue a wire. You could do a bank's official check. That's a possibility as well. One of the benefits that I've already mentioned is that you go to closing and you sign the closing documents. We'll discuss the transaction with you, make sure you're not dealing with disqualified parties or using any prohibited funds, and that you've got the proper name and titling. But we don't need to approve and sign the documents which are required. Many other companies, you do have to send those closing documents to them and they sign off on them. That is not a requirement of us. We need to see them in advance before we can send the funds, but you can actually go to closing. Now, you can send us, and you would want to send us copies of the closing documents, but you can keep the originals of those documents. Now, you can use borrowed funds, as I mentioned earlier. It does need to be a non-recourse loan. And a non-recourse loan is a special kind of loan that means the lender, if there's a default on the loan, only has recourse to the property that the loan is on. So no other recourse. I'll talk a little bit more about non-recourse loans. If you do use leverage to purchase a piece of real estate, then there is the possibility that UDFI, unrelated debt financed income, will be generated, and that is taxable. I'm going to go into an example of that. So just something to be aware. You certainly can use borrowed funds, but there will be some additional things to consider when you do that. So let's go back to purchasing real estate for a moment, and I want to talk about partnering with others. You can partner with anyone, including otherwise disqualified persons, at the inception of the transaction. If you do that, the ownership percentages of those parties can never change. So back to that example that I gave you. You have $75,000 personally, and your retirement account has $75,000. And you purchase together, at the inception of the transaction, a $150,000 piece of property. You each own it 50-50. That percentage can never change. So if additional funds need to be put into the property, the funds need to be put in equally because you are equal owners. If you needed to buy a new roof for your property and it was going to cost $5,000, you personally would have to pay $2,500 and your retirement account would have to pay $2,500. You have to keep that ownership percentage exactly the same if you have disqualified persons involved. All of the property expenses are paid based on that ownership. All the property revenues are distributed based on that ownership. So if you generate $12,000 in rental income in a year, $6,000 of that from this property would go to you personally, and $6,000 would come into your retirement account. So we certainly have clients who do this kind of a partnership, but you just need to be aware that you can't change that ownership percentage. Now, some of our clients do like to set up a sub-LLC, meaning an LLC that's within their bigger IRA LLC to own the property. And that's fine, you can do that. But all the rules that relate to retirement accounts still must be followed. It doesn't negate anything. You still can't participate with any disqualified persons. You know, if you did set up a sub-LLC, we would want to see the operating agreement for that sub-LLC. We want to know exactly who the owners are and the amounts that they are contributing into that entity and their percentage of ownership. And we would expect the percentages of ownership to match up with the amounts investment. It's actually a requirement if any of those parties are disqualified persons. So it gets a little complex, but we can do that. But you just need to remember that just because it's in a sub-LLC doesn't mean you can disregard the IRA rules. They still all apply. And disqualified persons cannot do rehab or repairs on a property owned or partially owned by your retirement account, or be a tenant, a buyer, or a seller. So you always want to remember that. I will mention here, because I often do have realtors, licensed real estate agents interested in this kind of transaction in their own retirement account. We encourage you not to be involved in any transaction that involves your IRA if you are a licensed real estate agent. It can be very tricky because, again, you are a disqualified person to your IRA. You can't receive any compensation personally because that would violate that rule. You know, if you did want to do it for free, and you could do it for free, you could use your real estate investing expertise, but you can't gain any personal benefit from the transaction that your IRA is engaging in. So as our client, if you're a real estate agent and you want to do that, we ask that you talk to us and let us help you be sure that you don't violate any rules. Let us help you walk through that type of a transaction. Now, I mentioned partnering with others. Your retirement account doesn't have to be the sole owner of an investment. You can be in partnership with others. And in fact, you can partner with yourself, your spouse, and family members. Now, if you'll notice, self and spouse are definitely normally disqualified persons, and ascendants and descendants are. But if this partnership happens at the inception of the transaction, then it is permitted. Again, those percentages can never change. You could partner with other people, other colleagues and investing colleagues. You can partner with LLCs, investment syndications. So you do have opportunity to co-invest with others in a self-directed retirement account. Now, I want to show you a little schematic of our structure to help you kind of visualize it. So you'll see in the upper left your current custodian, where you're currently holding your funds. When you decide you'd like to open an account with us, you would complete documents that would direct your current custodian to transfer or roll over, depending on what you're doing, funds to our self-directed custodian. While that is happening, our department at headquarters will be setting up an LLC for your retirement account in the state of your choice. Then once the monies have been received by our custodian and the retirement LLC is set up, then the money moves from the custodian to the bank account that your LLC has access to, and the ownership documents, subscription documents for their LLC move to the custodian. So once your funds are here in the bank account, you're ready to begin investing. And you'll see in this case, this retirement plan has a tax lien investment. They also have purchased a property for rehab and rental. That's investment number 2. And look at investment number 3. Investment number 3 has 3 other owners. There are 4 total owners. You pooled funds with others to purchase a small retail center. You took your father as one of the investors, your daughter is one of the investors, and some of your personal money. That is not a prohibited transaction as long as you co-invested at the inception of that purchase transaction. So again, whatever your ownership percentages are, it could be 50, 20, 70, 15, and 15. Whatever those percentages are, they don't have to be equal, but they have to stay the same. So this is just a little picture for you to kind of understand how this might work for you. Let me talk a little bit more about non-recourse loans. Again, this is the only type of loan that you can use if your retirement account is involved in leveraging a real estate transaction. A non-recourse loan simply means the security instruments, the notes and the mortgages, allow no recourse against the individual account holder or the balance in your retirement account. The only recourse is the property itself. That's the only source of repayment. Now, with a non-recourse loan, there's no income or employment verification because your retirement account is getting this loan and it doesn't have an income, it doesn't have a job. There are some general industry standards when you're looking for a non-recourse loan. Of course, you need to go out to do some due diligence and look for some lenders and find out what their specific requirements are. Generally, the required documentation is going to be, of course, a loan application. They're going to want to see a purchase and sale contract. They're going to want to see your IRA statement or other retirement account statement. They will likely want an appraisal of the property, and if it's a rental, they'll want a rent roll. Loan guidelines, the maximum loan to value is generally around 70%. So it means you're going to have to put down a larger down payment for a non-recourse loan than you would for a personally guaranteed loan. Maximum terms, usually 20 to 30 years. Some non-recourse lenders do offer adjustable rate mortgages, 315, 171. They're going to look for an income expense ratio of about 1.25 or higher, and they are going to require you to have some reserves held in your retirement account, say for unexpected expenses. You know, if the refrigerator goes out and you need to buy a new refrigerator, your retirement account has to be able to fund that purchase. So they will generally have a reserve requirement that you hold in cash in your retirement account or in liquid assets. Some properties are not eligible. Eligible properties, single-family residences, some condos, 2 to 4 plexes, multifamily homes, and retail, office, and warehouses. Those are eligible. Things that tend to be ineligible are mobile homes, timeshares, condo hotels, some restaurants. Again, you'd have to check with a particular lender. Residences with 5 or more acres, and farms. Those are usually not eligible for non-recourse loans. Now let me talk about I alluded to when a tax could come into play in a retirement account. Unrelated business income tax, of which UDFI, unrelated debt financed income, is a subset. This comes into play when you use leverage to purchase a real estate asset in your retirement account, when you use a non-recourse loan. Now, this tax applies to income that's generated from an asset that was purchased using financing. And the tax is based on the net income of the property. The first $1,000 is exempt, and you're only taxed on the percentage of the income that is attributable to the debt. So I will explain that it might be easier explained in an example. When the asset is sold, a percentage of the gain is also subject to UDFI. So let me walk you through an example. I think that's probably the simplest way to explain this. Let's say that you have purchased that rental property and it's 50% debt financed. Let's say it was, $100,000 selling price. You got a loan for $50,000 and $50,000 came from your retirement account. So your retirement account is the only owner. And you get your net rental income. So this is after expenses. We're going to make this easy to do the math. Your annual net rental income is $12,000, $1,000 a month. Now, the income that will be subject to UDFI is only $5,000. Remember, this is a 50% debt financed property. So that means only 50% of the net rental income is attributable to the debt. So that would be $6,000. And then remember that I said $1,000, the first $1,000 is exempt. So take that $1,000 off, and now we've got $5,000 that is subject to the tax. It is taxable at the trust tax rate. I took the highest trust tax rate I found. This may not be the exact one. You'd have to check with your tax advisor. But I picked the highest one I found, 39%. So that would mean that you would be paying on this rental property that you had leveraged in taxes $1,950. So that would mean that your net income on this property for this year after taxes is $10,050. So when you're thinking about using debt financing, you want to kind of think through, okay, I don't like paying taxes, but if I can do a transaction that I can't otherwise do without leverage, and if I'm earning enough after the tax, is it a good transaction for my retirement account? So that's the kind of scenario you want to walk through when you're deciding about this. So again, UDFI, unrelated debt financed income, it's reported to the IRS on Form 990T. It is taxable at the current trust tax rate, and you will need to discuss with your tax advisor. Please know that this tax must come out of your retirement account. So you've had those earnings come into your retirement account, the tax needs to be paid out of that retirement account. You can't pay it personally. That would be a violation of that disqualified person prohibited transaction rule. So the taxes do come out of your retirement account where the monies went in. So I hope that kind of gives you an idea of how real estate investing would work in a self-directed retirement account with FTC, and how using leverage might work, and a little bit of information about if taxes come into play if you are using leverage. Now I want to go to your questions. So what I'd like to ask you to do, if you haven't already, is to type any questions into the question box. And while you are doing that, I'm going to open up my question box. Okay, just looking at these questions. Okay, what is the time frame to get my account up and running with FTC? Typically, we say that it's 4 to 6 weeks from the time of the original paperwork, the time we receive it in our office. And that is because there is time to get the monies from your current custodian to our custodian, time to set up the LLC and the state of your choice, and then the movement of the funds. Typically, it takes much less than that. But we do ask for that amount of time. So if you are already looking at possible investments to invest in, please do get your paperwork set up if you aren't already a client. Can you open an IRA if you are over 60? And what is the minimum initial deposit? Yes, you can if you meet a couple of criteria, and this information can be found in IRS Publication 590. If you file a joint return, your spouse received taxable compensation during the year, and you were not age 70 and a half by the end of the year, then you can open an account or make contributions to an account. The amount to open an account with us is $250. Again, you can just transfer funds to us. You don't have to make a new contribution to open an account with us. Can you give me some ideas for possible investments for smaller accounts? Yes, certainly. Tax liens are generally much smaller in amount, so you could invest in tax liens. You could also make private notes to others. You could be a lender to a real estate investor and then have that property as collateral security for that loan that you've made to them. So you could also partner with others to co-own the investment. So those are some possibilities for a smaller account. Can I purchase a property with funds in my retirement account and then sell that property and hold the mortgage for the new buyer in my account? Yes, you can, as long as that buyer isn't a disqualified person, absolutely. So yes, you can hold the mortgage and you could have the property as security for that mortgage. Okay, this is not a real estate question. Can I use funds from my retirement account to purchase a franchise? You would need to check with the franchisor to see if an IRA owner is permitted. If it was permitted, you personally could not be active in running that franchise. It would have to be a passive investment for your retirement account. Okay, I'm going to hold off on that question for a moment. Well, I'll go ahead. How are taxes calculated on assets that are converted to a Roth IRA? I didn't really talk about Roth conversion tonight, but you can. I did mention that Roth earnings were tax-free when you took qualified distributions. So some people are interested in Roth accounts and interested in converting from a traditional IRA to a Roth IRA. And when you do that, taxes are incurred because the monies that you invest, into a Roth, the contributions are taxed. So if you're putting money into a Roth account, it's going to be taxable. So converting from a traditional that you didn't pay tax on to a Roth is going to have a tax consequence. Taxes are going to be paid on the market value of the account assets as of the date of the conversion, and they would be payable at your ordinary income tax rate. So that is a question. If you are considering converting to a Roth, you will want to discuss with your tax preparer on the tax consequences of that and how you might want to go about doing that. I have both a Roth account and a former employer 401k plan. Can they be combined in the same LLC? No, unfortunately, they cannot, because those are two different kinds of money, pre-tax and post-tax. So they must be held in two different kinds of accounts. Can I use my IRA funds to make an investment with my spouse? Typically, no. You're prohibited from engaging in transactions with your spouse or your spouse's IRA. But if you do that at the inception of the transaction, if it's structured properly, you can. And so we encourage all of our clients to call and discuss any of those types of complex transactions in the early stages so that we can provide you with information to make sure that you stay in compliance with the rules. Okay, here's a question. If you have a rental property in your account, who does the renter send the rent check to? And that really depends on whether or not you are using a property manager. We do highly recommend that you use a property manager so that you can stay at arm's length from your retirement account transactions. A property manager would typically collect the rent and the checks would be made payable to them, and then they would forward to us, made out to your IRA LLC, the excess funds. If you're not using a property manager, then the checks would be made payable to your IRA LLC, not to you personally. That would be a no-no. Payable to your IRA LLC and then mailed to our office. They could send that check to you, but then you would have to send it to us. So we can just eliminate that and you have them send it directly to FTC. And then that would be deposited into your retirement account's IRA LLC. Okay, we've got a few questions here that were asked in advance. Okay, here's one that just came up. Can my IRA partner with my son to purchase a rental property? Can my husband's IRA also join that purchase? Normally, your son and your husband's IRA would be disqualified persons. However, as I said, if you structure that properly and you all co-invest at the inception of the transaction, yes, you can do that. And so that would be a transaction that you would want to talk with our client services department about to make sure that all of the documents are titled properly throughout the process. The offer and then the HUD or whatever documents for purchasing that property, because that, again, that has to be written properly, but it can be done using a self-directed account with an IRA LLC. Okay, another very good question. If you purchase an asset with a non-recourse loan, you are subject to UDFI tax. If you subsequently pay off the non-recourse loan, are you still subject to the UDFI tax? Let me answer that. Once you've paid off the loan, no. Then the future earnings are not subject because you no longer have that loan. Now, if you sell the property before that loan is paid off, in fact, if at any time in the previous 12 months prior to the sale, you have had outstanding loan, then the sale proceeds are going to be subject to UDFI. Now, how they're subject is different than by ownership. It's going to be based on sales price. So it's a little bit a different calculation. And since you've been paying down that loan, less of the proceeds would be subject because less of the property is leveraged. So once the loan is paid off, any future earnings are not subject to UDFI because there's no longer a loan. But if you sell that property and realize a gain on that, that gain, if there's been any outstanding loan in the previous 12 months prior from the date of that sale, then there will be some tax on the sale appreciation, what you've earned. Okay. Okay, how difficult is it to own a rental property? Not difficult, just find one and do it. Would I need to keep plenty of cash in the account for repairs and maintenance and would I be allowed to manage the property? Okay, we don't require you to have a certain amount of reserves in your retirement account for a rental property that your account owns. But you must be aware that if expenses come up, you do need to be able to pay those from your retirement account. And if you don't have the funds there, you need to be able to make an allowable contribution. And if you can't make an allowable contribution, that's a problem. So you might want to consider keeping some reserves in your retirement account, or make sure that you have the ability, you are able to make a contribution, an allowable contribution that would cover those expenses. I'm sorry, my time is up. I see I have a couple more questions. I will answer those privately. If additional questions come to your mind, please do send me an email. Let me move my screen so that you can see our information. This is our website, stcira.com. There's a lot of information there that may be helpful to you. Our corporate office number is there, and my email is there. So these questions that I didn't get to, I will answer personally, and please feel free to contact me at any time with any additional questions. We would be happy to assist you. If you are interested in a self-directed retirement account, we would be happy to talk with you about that, see if we're a good fit for you, and we can get documents to you so that you can get that open as soon as possible. We do educational webinars once a month. We do have another educational webinar coming up next month. I believe it's on different types of assets that you could own other than real estate in your retirement account. So you may be interested in coming to that webinar as well. I always give some general information about self-direction in each webinar, because I know that I have new listeners all the time and that self-direction may be unfamiliar to them. So please do join us if you would like. You can register from our website, or if you received an email invitation to this webinar, you will likely get one to the next one as well. So thank you so much for joining me this evening. We appreciate it, and we wish you a good night. Thank you.